Welcome back. You're watching Big Deal and we are discussing the value unlocking and investor exit propositions in the startup space. Now, Karan, we were discussing the IPO market, the valuations. I want your view on the valuation metrics because we did take the example of Mama Earth, which is a recent listing from this space, and its valuations something that we can now draw analysis from for the future IPO pipeline from this space, and versus the secondary sale. So which is the theme which is picking up, and how are the valuation matrices working out?
Sure. So Nisha, the good part is that the industry, especially on the tech side, and most of the IPOs that we expect, we will see far more on the consumer side of it. We'll see fewer on the B2B, SaaS side. So on the consumer side, the good part is the conventional industry players there's a lot of listed peers. People are looking at EBITDA multiples forward 1 to 2 years. And the good part about Indian public markets is we look at a certain growth profile, which is 20-25% onwards. We see a healthy ROCE profile, which is return on capital employed. And if you look at a bunch of 30 to 40 such large consumer retail listed peers, you'll see EV by EBITDA multiples right from 25 to 35x zone. And that's how most of the investors are approaching these tech startups. Obviously, they're applying these multiples more on what the stable state EBITDA of these companies could be in the next 12 to 24 months, and then discounting it back. So the good part is the discussion is more about now EBITDA multiples rather than revenue multiples or GMV multiples, which was maybe a scenario 2 to 4 years back. But that is undergone a change. And on to your second question on how one should think about the secondaries and the public market scenarios, I think it's a sequencing aspect as I would like to see. See, in India, companies would always take a bit longer, in their journey to list, which means how a typical VC or a private equity investor, the investment time period that they would assume for them to see an exit in a company. In India, it could be a couple of years longer than, say, a mature market like the US, which means that if they are, 4 to 5 years into their investment journey in a company, then secondaries are an interesting option for them to sell part or large portions or even full secondary stake to another private equity or a secondary focus fund. So that rollover, ensures that there's not too much of pressure on the cap table when the company looks to list. Yes. And the fresh pair of investors who are there in the next phase of journey for the next 3 to 5 years. So we see secondaries as a good kind of a product for investors to explore and have an interim return option for them as compared to pegging hopes on a long-term IPO journey. So it's a combination of both that should solve the overall, I would say, liquidity requirements of the investors.
A very important point made by you there, Karan, because as from what I have understood, the private equity industry, which is much more progressed in terms of understanding the public market, the IPO, as well as the growth stage companies, probably can act as a buffer for even the IPO preparedness of the companies. Rahul, what's your view on that, and how is this trend really picking up for the VCs?
Nisha, fortunately in our case, we do have a longer time horizon. So our funds are typically 10 plus 2 years. What this means is we can stay with the startups at least from 7 to 10 years. And if need be, extend that journey as well. So if we think that the company can go IPO in, let's say, 12, 14 years also, we are perfectly open to staying along with that. Giving or getting some secondary exit has a different motivation. It is less to do with, is the company taking too long? It is more to do with providing some liquidity to our own investors. And we actually did that in Mama Earth also in 2020. I think we took a small stake that we sold, but stayed with the company for a larger stake of ours. So yes, if you are a fund which is much shorter time horizon, I think founders should understand when they raise money from those investors that, in 5-7 years, there has to be some exit that needs to be provided. In our case, fortunately, that's not needed.
All right, not in your case, but Disha, Coming to you as a founder, what about the IPO preparedness from the founder community? You, I'm sure, have a conversation with several other entrepreneurs of your type, and how are the change in the view that public market takes on the matrices being accepted? How is that approach being seen, and are founders able to really prepare their companies on those matrices?
I think as Karan and Rahul both have said that, a lot of things have changed in the ecosystem in the last 2 to 3 years. The matrices that we were looking at 2-3 years back are not something that we were so keenly looking at right now. Of course, growth is important, top line is important, but I think founders are also realizing, and I think the overall ecosystem is also realizing this, that if in 5 to 7 years you want to go IPO as a company, then there are a few more matrices that you need to look on, and the most important one of them would be, of course, capital efficiency and being EBITDA positive, as Karan was saying, because that's what public markets values the most, and that's the change that we are also seeing across it. And I think at Zouk we have always taken pride in being capital efficient for the very long time, and I think that's how we are building our business. Given Nisha, Zouk is our life's work, and I think we want to take Zouk IPO in next, maybe 5 to 6 years. And now we understand from all the IPOs which has happened in the last 2 years that it does take its own time to prepare for the IPO, and the matrix, like the preparedness might happen 2 years back from the date of IPO that you want to go, but the whole matrix focus has to start from the very, very beginning, maybe 5-6 years before when you think.
No, that's right. You have to be prepared for right from the beginning, and there are several aspects to it in terms of cash generation, EBITDA positive, and also the corporate governance standards. Very quickly, Karan, final word. You said that M&A is not something that is ringing in well in this particular space. Any particular view on that? And do you see a theme picking up even in terms of consolidation, VC-led consolidation, anything that you see on the horizon? Very quickly.
Sure. So, Nisha, we see, a lot more scrutiny on capital deployment of larger companies by their boards as to, where they believe they could be good acquisition targets. I would say market consolidation in terms of equity swaps between companies could increase, marginally over the next, I would say, year or 2 years. However, very large cash M&A exits is something that, we believe in some of the key sectors that we track closely. We don't see that as a big outcome. Yes, there could be smaller, few $100 million worth of smaller acquisitions that companies could do for cash, but large consolidation would largely be with mergers and largely more equity swaps, less of cash deployment.
That's right. Okay, so consolidation could be there with share swap. But one thing I wanted to just put across, that the public markets want what's the bottom line. And that's been the focus of the public markets. And the startup world has come around and has been on track to profitability when they have to make it to the IPO market. So that's one big change that has really taken place. Thank you so much, Rahul, Disha, as well as Karan, for joining us for this interesting conversation. With that, it's a wrap on this edition of Big Deal. Thanks so much for tuning in.